In 1889, a small group of Seattle businessmen pooled together $300,000 to create what they called the Washington National Building Loan and Investment Association. Their modest goal was simple: help working-class families achieve the American dream of homeownership. For over a century, this institution would grow from a regional savings and loan into Washington Mutual, affectionately known as WaMu, becoming the sixth largest bank in the United States with assets exceeding $307 billion. But on September 25, 2008, in the largest bank failure in American history, federal regulators seized WaMu and sold it to J.P. Morgan Chase for a mere $1.9 billion. What transformed a conservative community bank into a reckless gambling house that nearly brought down the American financial system is a story of greed, regulatory failure, and the dangerous pursuit of endless growth. The early decades of Washington Mutual told a different story entirely. The company survived the panic of 1893, the Great Depression, and two world wars by maintaining conservative lending practices and focusing on its core mission of helping families buy homes. By the 1980s, WaMu had evolved into a traditional thrift institution, taking deposits from customers and using that money to make home loans. The bank's advertising emphasized its friendly, customer-focused approach with the slogan, "The Friend of the Family," and its branches were designed to look more like living rooms than sterile banking halls. During this period, WaMu operated under strict regulations that limited how much it could lend and to whom, keeping risk levels manageable. The savings and loan crisis of the late 1980s and early 1990s actually benefited WaMu, as the company acquired failed competitors at bargain prices, expanding its footprint throughout the Pacific Northwest. By 1994, Washington Mutual had become the largest savings and loan in the United States. The transformation of WaMu from conservative lender to subprime predator began in earnest with the arrival of Kerry Killinger as CEO in 1990. Killinger, a former aerospace engineer turned banker, had grand ambitions to turn the regional thrift into a national powerhouse that could compete with banking giants like Bank of America and Wells Fargo. Under his leadership, WaMu embarked on an aggressive acquisition spree, purchasing banks and mortgage companies across the country. The company went public in 1983 and used its stock as currency to fuel rapid expansion. Killinger's strategy was to transform WaMu from a traditional bank that made money on the difference between what it paid depositors and what it charged borrowers into a mortgage factory that could originate loans and sell them to investors. This shift from a hold-to-maturity model to an originate-to-distribute approach would prove catastrophic, as it removed WaMu's incentive to ensure borrowers could actually repay their loans. The real turning point came in 1999 when WaMu acquired Long Beach Financial Corporation, a California-based subprime lender that specialized in making loans to borrowers with poor credit histories. Long Beach had pioneered many of the exotic mortgage products that would later become synonymous with the housing bubble, including interest-only loans, adjustable-rate mortgages with teaser rates, and stated income loans that required no documentation of a borrower's ability to pay. WaMu's executives were initially skeptical of these products, but the profits were too tempting to ignore. Long Beach was generating enormous fees by originating these risky loans and selling them to Wall Street investment banks, which packaged them into complex securities called collateralized debt obligations. Within a few years, WaMu had adopted Long Beach's business model across its entire mortgage operation, abandoning the conservative underwriting standards that had sustained the company for over a century. By the early 2000s, WaMu had become the poster child for everything wrong with American mortgage lending. The bank offered a dizzying array of exotic loan products designed to get borrowers into homes they couldn't afford. The most notorious was the option arm, an adjustable-rate mortgage that allowed borrowers to make payments so small they didn't even cover the interest, causing the loan balance to grow over time through negative amortization. WaMu marketed these loans aggressively to borrowers who didn't understand the risks, often highlighting only the low initial payment while burying the details about rate adjustments and payment shock in fine print. The bank also became a major player in the ninja loan market, offering mortgages to borrowers with no income, no job, and no assets. Internal emails later revealed that WaMu executives knew these products were dangerous, with one employee writing that the option arm was like putting people in torture chambers. But the profits were too lucrative to stop, as WaMu was earning billions in fees from originating and selling these toxic mortgages. The culture at WaMu became increasingly toxic as the mortgage boom intensified. Loan officers were paid based on volume rather than quality, creating perverse incentives to approve as many loans as possible regardless of the borrower's ability to repay. The bank established what it called loan production offices in strip malls and storefront locations, staffed by commissioned salespeople whose job was to push the most profitable loan products. WaMu's marketing materials actively encouraged borrowers to lie about their income, with one flyer asking, "Stated income, stated asset. Don't want to provide income documentation? This program could be the loan for you." The company's own internal audits found widespread fraud and quality control failures, with loan files missing critical documentation and borrower information that was clearly fabricated. But rather than address these problems, WaMu executives pressured underwriters to approve more loans and fired employees who raised concerns about loan quality. The bank's chief risk officer resigned in 2005, warning that WaMu was taking on too much risk, but his warnings were ignored. As the housing market began to show signs of stress in 2005 and 2006, WaMu doubled down on its risky lending strategy rather than pulling back. The bank continued to originate billions of dollars in subprime and Alt-A mortgages even as default rates began to climb and other lenders started tightening their standards. WaMu's executives publicly dismissed concerns about the housing market, with CEO Killinger telling investors that the bank's loan portfolio was pristine and that housing prices would continue to rise indefinitely. Internally, however, the bank was struggling with rising delinquencies and falling profit margins as the secondary market for mortgage-backed securities began to dry up. WaMu was forced to keep more loans on its books rather than selling them to investors, exposing the bank directly to credit losses for the first time in years. The company's stock price began to decline as investors grew concerned about WaMu's exposure to the deteriorating mortgage market. The beginning of the end came in 2007 when the subprime mortgage crisis exploded into public view. Major investment banks like Bear Stearns and Lehman Brothers faced massive losses on mortgage-backed securities, and credit markets froze as investors lost confidence in any investment tied to real estate. WaMu found itself trapped with billions of dollars in toxic mortgages it couldn't sell and a loan portfolio that was hemorrhaging money as borrowers defaulted in record numbers. The bank reported a net loss of $1.87 billion in the fourth quarter of 2007, its first annual loss since 1992. Desperate to raise capital, WaMu accepted a $7 billion investment from TPG Capital, a private equity firm, in April 2008. But the investment came at a steep price, with TPG receiving preferred shares that paid an 18% dividend, reflecting the market's assessment of WaMu's dire condition. The capital infusion briefly stabilized the bank, but it wasn't nearly enough to cover the mounting losses from WaMu's toxic loan portfolio. Throughout 2008, WaMu's condition deteriorated rapidly as the mortgage crisis deepened into a full-blown financial panic. The bank continued to report massive losses, burning through the TPG capital injection within months. Depositors began to lose confidence in WaMu's stability, leading to a slow-motion bank run as customers withdrew billions of dollars from their accounts. The situation became critical in September 2008 when Lehman Brothers collapsed and the financial crisis reached its peak intensity. In just 10 days, from September 15th to September 25th, WaMu customers withdrew $16.7 billion, representing nearly 10% of the bank's total deposits. Federal regulators, already concerned about WaMu's massive losses and inadequate capital, decided they couldn't risk the panic spreading to other banks. On the evening of September 25, 2008, the Office of Thrift Supervision closed Washington Mutual and transferred control to the Federal Deposit Insurance Corporation. The FDIC immediately sold WaMu's banking operations to J.P. Morgan Chase for $1.9 billion, less than 1% of the bank's assets just months earlier. The collapse of Washington Mutual sent shockwaves through the financial system and marked a turning point in the 2008 financial crisis. With $307 billion in assets, WaMu's failure dwarfed previous bank collapses and demonstrated that even the largest financial institutions were not too big to fail. The FDIC's insurance fund took a hit of approximately $30 billion to cover WaMu's insured deposits, the largest loss in the agency's history. Shareholders were wiped out completely, losing over $40 billion in market value from the bank's peak. Bondholders also suffered massive losses as their investments became worthless overnight. The speed of WaMu's collapse shocked even seasoned regulators, as the bank went from operating normally to being seized and sold in a matter of hours. JP Chase, which had been circling WaMu like a vulture for months, acquired the bank's 2,200 branches and 43,000 employees at a fire sale price, instantly becoming the largest bank in the United States by deposits. The deal allowed JP to expand its retail banking footprint across the country and eliminate a major competitor in the mortgage market. The aftermath of WaMu's collapse revealed the full extent of the damage caused by the bank's reckless lending practices. Congressional investigations and internal documents showed that WaMu had originated over $270 billion in toxic mortgages between 2003 and 2007, many of which were sold to unsuspecting investors around the world. The bank's failure contributed to the broader collapse of the mortgage-backed securities market and helped trigger the worst recession since the Great Depression. Thousands of WaMu employees lost their jobs, while borrowers who had received predatory loans faced foreclosure and bankruptcy. The communities where WaMu had been most active in subprime lending, particularly in California, Florida, and Nevada, experienced devastating housing market crashes that took years to recover from. Legal battles over WaMu's collapse continued for years, with shareholders, bondholders, and creditors fighting over the remnants of the failed bank. Several class action lawsuits were filed alleging that WaMu executives had misled investors about the bank's true financial condition, but most shareholders recovered little or nothing from their investments. The rise and fall of Washington Mutual serves as a cautionary tale about the dangers of abandoning prudent banking practices in pursuit of short-term profits. A company that had survived for over a century by helping families achieve homeownership was destroyed in less than a decade by executives who prioritized growth and profit margins over the long-term health of the institution. The transformation of WaMu from a conservative thrift to a subprime lending machine illustrates how financial deregulation and perverse incentives can corrupt even well-established institutions. The bank's collapse also highlights the systemic risks created when large financial institutions abandon their traditional role as careful stewards of capital and instead become speculative enterprises focused on fee generation. Today, the WaMu brand is nothing more than a historical footnote, a reminder of how quickly hubris and greed can destroy even the mightiest financial institutions. The lessons of Washington Mutual's failure remain relevant as regulators and policymakers continue to grapple with the challenge of preventing future financial crises while maintaining a healthy and competitive banking system.